Ever wondered how to find undervalued stocks? Welcome to the fascinating world of value investing, where the thrill of the hunt is as exciting as the potential profits. This approach is all about finding stocks that are worth more than their current market price. Imagine finding a hidden gem, a diamond in the rough, and then watching its value soar. Now, why is this important? Well, investing in undervalued stocks can offer better returns and lower risk. Think of it as buying a dollar for 50 cents. Sounds like a good deal, right? But how do you find these undervalued stocks? That's the million-dollar question. The answer lies in a mix of careful market research, understanding financial ratios, and always ensuring a margin of safety. It's not just about numbers, it's about understanding the story behind those numbers. So, are you ready to uncover the secrets of value investing? Stay tuned to uncover the secret to finding these hidden gems in the stock market. But first, what exactly is an undervalued stock? Well, let's break it down. An undervalued stock is, in essence, a hidden gem in the stock market. It's a stock that's trading for less than its intrinsic value. Now, you might be wondering, what's intrinsic value? It's the actual value of a company, considering all aspects such as its earnings, its assets, its liabilities, and its future potential. It's the real worth of the company, not just the price that the market currently assigns to it. So, when a stock is trading for less than this real worth, it's considered undervalued. It's like finding a designer dress on a discount rack. The price tag is lower, but the quality of the dress doesn't change. It's still a designer dress. That's an undervalued stock for you. Now that you know what an undervalued stock is, let's delve into how to find them. The first step in finding undervalued stocks is thorough market research. Imagine market research as the compass guiding you through the dense forest of the stock market. It's that critical tool that points you in the right direction, helping you uncover those hidden gems, the undervalued stocks. Now, you may wonder, how does one conduct this market research? Well, it's a two-pronged approach. First, you delve into the industry, and second, you examine the company. When researching the industry, think big. Look at the industry's growth prospect, the competitive landscape, and any regulatory or technological changes on the horizon. You can find this information in industry reports, which are often available for free online from various financial news outlets. Then, you zoom in on the company. Here, you'll want to understand the company's business model, its competitive advantage, and its financial health. You can glean this information from the company's financial statements. A company's financial statements are like its report card. They reveal how the company has performed in the past and provide clues about how it may perform in the future. The key statements you'll want to review are the income statement, the balance sheet, and the cash flow statement. In addition to financial statements, you should also keep tabs on financial news. This includes earnings reports, news releases, and any other significant events that might affect the company's stock price. But remember, market research isn't a one-time task. It's an ongoing process. The stock market is dynamic, ever-changing. Therefore, it's crucial to keep up with the latest news and updates about the industry and the company. Finally, don't forget to cross-reference your findings. Look for consistency across different sources. This will help you build a well-rounded understanding of the company and its industry. Remember, the more you know about the company and the industry, the better your chances of spotting an undervalued stock. The next step is to dive deep into the company's financials. We're now going to explore the realm of financial ratios. These are the tools that can help you identify undervalued stocks. The key ratios we'll look at are the price-to-earnings ratio, or PE, the price-to-book ratio, or PB, and the debt-to-equity ratio. Let's kick off with the PE ratio. This ratio is calculated by dividing the current market price of a stock by its earnings per share. A lower PE ratio could signify that the stock is undervalued. However, it's essential to compare this ratio with other companies in the same industry to get a meaningful insight. Next up is the PB ratio. This ratio compares a company's market value to its book value, which is the value of a company if it were to liquidate all its assets. A lower PB ratio could indicate that the stock is undervalued. However, like the PE ratio, it's best to compare it with other companies within the same sector. Lastly, we have the debt-to-equity ratio. This ratio measures a company's financial leverage by comparing its total liabilities to its shareholders' equity. A lower debt-to-equity ratio typically means a more financially stable company, which can be an attractive feature for value investors. While these ratios can provide valuable insights, they should not be used in isolation. Instead, they should be part of a broader analysis that includes other factors such as the company's competitive position, the quality of its management, and its future growth prospects. Remember, the goal is not just to find cheap stocks, but to find undervalued stocks. These are stocks that are trading for less than their intrinsic value. In other words, they're on sale. But always bear in mind, while these ratios can help you identify potential bargains, they aren't foolproof. There's always a risk when investing in stocks, so it's important to do your homework and make informed decisions. By understanding these financial ratios, you can get a clearer picture of a company's true value. The final step in finding undervalued stocks involves identifying a margin of safety. This principle is a cornerstone of value investing, a concept that was first introduced by the father of value investing himself, Benjamin Graham. So, what exactly is a margin of safety? Imagine it as a buffer, a protective barrier, if you will, that shields you from potential losses. It's like wearing a seatbelt when you're driving or a helmet when you're cycling. You may not need it, but having it sure does provide peace of mind. In the context of investing, the margin of safety is the difference between the intrinsic value of a stock and its market price. In other words, it's the amount by which the price of a stock is below its actual worth. This gap, this safety margin, allows for human error, bad luck, or extreme volatility in a tough market. It provides a cushion against the unexpected. Now you might be wondering, how do we calculate this margin of safety? Well, it's quite simple. You subtract the market price of the stock from your estimated intrinsic value of the stock, and then divide that number by the intrinsic value. The result is your margin of safety, usually expressed as a percentage. The larger this percentage, the greater your safety margin. But why is this so important? I mean, isn't it enough to just find a stock that's undervalued? Well, not quite. The market is a tricky beast, often unpredictable and sometimes downright erratic. By insisting on a margin of safety, you're taking a step back, giving yourself room to navigate these uncertainties. It's about being prudent, about not risking more than you're comfortable losing. It's about acknowledging that we don't have a crystal ball to predict the future, and preparing for that reality. A margin of safety can be your best friend when it comes to investing in undervalued stocks. It's the lifeline that could save you from significant losses and help boost your overall returns. Remember, in the world of investing, it's not just about making profits, it's also about preserving capital and minimizing risk. Finding undervalued stocks might seem like finding a needle in a haystack, but it's not as daunting as it sounds. We've navigated through the complex labyrinth of value investing together, and now we're standing at the end of the journey, ready to recap the key points we've covered. Firstly, we delved into the world of undervalued stocks. These are the hidden gems of the stock market, the shares that are priced lower than their intrinsic value. This intrinsic value is the actual worth of the company, considering all its assets and potential for growth. But how do we uncover these diamonds in the rough? That's where our next point comes in. Our second point was the crucial role of market research. We emphasized that you can't simply rely on current stock prices to determine their value. Instead, you need to dig deeper. You need to understand the company's industry, its competitors, and its growth prospects. It's about looking beyond the numbers and understanding the story behind the company. Next, we discussed the importance of analyzing financial ratios. These are the tools that help us make sense of a company's financial health. They help us understand whether a company is overvalued or undervalued. We talked about crucial ratios like the price-to-earnings ratio, the debt-to-equity ratio, and the return on equity. Each of these ratios gives us a different perspective on the company's financial position. Lastly, we touched upon the importance of identifying a margin of safety. This is the buffer that protects you from potential losses, the safety net that ensures you don't lose your hard-earned money. The larger the margin of safety, the lower the risk. It's about finding companies that are not just undervalued, but significantly undervalued. In a nutshell, finding undervalued stocks involves a careful balance of understanding the stock, conducting thorough research, analyzing financial ratios, and ensuring a safety margin. It's a journey that requires patience, diligence, and a keen sense of judgment. Remember, finding undervalued stocks is an art, not a science. Happy investing.